Hey, we're live. All right, here we go. We are on Michael's Spaces. We are streaming to YouTube, and we should be streaming to Twitter. So welcome everyone to a special live stream on Let's Talk Markets. Michael, thanks for joining us. Very much appreciate you coming back on the program. You were actually, I think you were our very first guest on Let's Talk Markets to
It's
kick off
it's
our
it's,
podcast.
it's very possible, and if I was, I guarantee you, I was a lot heavier when I was.
You're looking magnificent, man. It's
I not exquisite.
exquisite. You know, where was my head?
You know my
Few
vernacular. You know my
few
vernacular.
understand.
Yeah,
Yeah.
you know.
Yeah, Michael is fasting. He is 2 days into a fast. So if he babbles off incoherently, we got to blame it on the lack of
No,
food.
you just blame it on my intelligence level. You don't blame it on. I'm just born this way, man. That's it. I'm incoherent as it is. I'm a New Yorker and I speak fast.
Yeah, good. Well, I'm from the better part of that area, Jersey, and I also speak fast. So here we go. We're here to talk about the yen carry trade. We're here to talk about the craziness in markets. We're here to talk about what Michael's been talking about, shouting from the rooftops for quite a while now. So let's get started. I think a lot of people have seen what's taken place in markets over the last 2 days. But why don't you, if you don't mind, start? I'd be really interested, and given that your name is Lead Lag Report, I'd be interested in your read on the sequence of events that happened, and what led what, because I still think there's a little confusion about that.
Okay, so let me go back to the beginning. What has been nagging me for the past year and 3 months, let's call it? What's been nagging at me is a clear divergence of messaging between U.S. small cap stocks and U.S. corporate credit. Okay, well, we're talking about Japan. How does that have to do with anything? Okay, hold on. Small caps have gone nowhere for the better part of a year plus, all while everybody's been chasing the momentum of large cap AI. Why have small caps not done all that well? Because the concern is a lot of these small cap companies will not be able to make it in a higher for longer environment. Right? It's very simple. Zombie companies, they're going to go bankrupt. Mm-hmm. So there's been this headwind of concerns around ongoing concerns, right, as far as these companies staying in business. So small cap investors, I would argue, have been worried about default risk on a company level. That's why these stocks haven't done all that well. Meanwhile, credit spreads have stayed very tight, meaning the differential between U.S. AAA high quality and junk debt has been very narrow, which tells you that the bond market is not worried about credit risk.
Corporate credit spreads.
Corporate credit risk. Right? So small cap stocks are clearly worried about credit risk. Junk debts, someone at my front door. Junk debt is clearly worried about, clearly not worried about default risk. So one of them is wrong, right? Small caps versus credit spreads. Okay. Now, then you start saying to yourself, okay, what resolves that? How can you resolve that disconnect? So you start looking at what do credit spreads correlate to? They correlate to volatility. Mm-hmm. Meaning as volatility rises, credit spreads widen. Default risk increases. So you need volatility to rise to resolve the disconnect of the message of small caps to the message of corporate credit. So then you start saying to yourself, okay, or is it going back to your point about what's the sequence of events, the order, the way I kind of came to the conclusion. You look around the world and you say to yourself, okay, what can be a spark to volatility? Mm-hmm. Spark to volatility is always some deleveraging. Okay, so what has been a source of leverage? You then look across the world, you look across the globe, you look at all these central banks, you say to yourself, okay, every single central bank has raised rates to try to squash inflation, but one. Bank of Japan. Mm-hmm. And then I started thinking to myself, okay, I remember very well in 2007, 2008, the carry trade being one of the reasons why in 2008 you had the great financial crisis.
For sure. Yep.
Right. So it didn't take much for me to kind of draw the conclusion that Japan would be a source of that volatility that would shock default risk into U.S. corporate credit, that the reverse carry trade was a legitimate risk, especially when you start thinking about Japan as an importer of oil and what oil priced in yen was doing, okay, combined with just tremendous complacency around inflation ever picking back up in Japan. Right? Now, I did not think it would happen in the last 4 trading days. It's one of those things where I always go back to the example of, I know when it's raining, but I don't know the exact mile marker. I might crash my car. Right. I mean, and that's always what's kept me up at night myself. It's like, well, if I'm right, I certainly hope my strategies, my funds get it right too. One of them did not. The majority of my funds, rules-based wise, did. But it really does go back to the disconnect between small caps, junk debt, corporate credit, and then thinking about what's the spark of volatility, which is driven largely through deleveraging. What's the biggest enabler of leverage? It's the Bank of Japan.
Mm-hmm. Okay, so you just mentioned oil priced in yen. I saw you tweet about that. Just take us through that. What has it done? Why is it important?
Japan imports all of its oil.
Mm-hmm.
Like, just start with that kind of very blunt force. So Japan imports all of its oil. Oil is denominated in dollars. Right? So if Japan's going to import oil, they have to first convert to dollars to get the oil. Problem is, the weaker the yen gets, the more oil priced in yen goes up because they have to convert to dollars, right? So now you're talking about a country which is old, where there's more diapers that are being bought for senior citizens than for babies, a country of savers, a culture that's very proud, okay? And now suddenly you've got horrendous debasement of the currency, of the yen. And then on top of that, cost-push inflationary pressure from oil, which is imported. So then you say to yourself, okay, Japan clearly cannot control the price of oil, but they can somewhat control the price of yen.
Mm-hmm.
They can manipulate it. So control what you can control. So let's control the yen as your source of making oil come down in terms of your imports. Now, against that backdrop, there has been a tremendous amount of speculative short positioning against the yen anyway. Right. So
that's the carry trade, right? They're selling yen, right? Taking the proceeds from that, putting it into higher yielding assets.
Right. So part of my thesis was it wouldn't take much to cause a squeeze. And if you have a squeeze that lasts for some number of weeks, so that recency bias kicks in by investors and traders, mm-hmm. then that creates a forced margin call, right? Which I think it partially explains why we woke up Monday morning and the VIX touched 65.
Mm-hmm.
I mean, at the peak.
That was crazy.
Like, oh, where'd that come from? Yeah. But it's like, it was not it was surprising to me it's not surprising to me that you end up having that kind of amplitude, right? Because it's been a long time coming. Now, I keep cautioning on this point that the last thing you want to do in this environment, if I'm right that we're still early stages, is short the market. Right? Mm-hmm. And I'm saying that very purposely because as we're seeing, big downs tend to be followed by big ups, which tend to be followed by big downs. I mean, this is what volatility is, right? I mean, it's people get so obsessed with direction, they should be thinking about volatility sequencing, right? So if we're in this reverse carry trade dynamic that will metastasize, I think, into corporate credit imploding in the U.S., it's going to be violent both directions.
Mm-hmm.
Right? And it's going to take time to play out.
So the mechanics for that are, again, these firms have sold yen in order to buy assets. They have been chasing yield and therefore pouring money into junk debt, which is and you think that explains the disparity that you're observing in credit spreads?
I think it's possible that is a driver of it, as well as explains why there's been so much demand in private credit. I mean, okay. I do think it goes back. It is it's a spread trade.
Yes, right. And so the unwind is you have to go cover your yen shorts, which means you have to raise money to do that, which means you have to sell junk, which means junk spreads start to blow out, which means that those companies can't borrow and they start to go out of business.
Well, or at least the fear of that is what takes hold, right? And okay. People forget that, junk, private credit, these are not liquid parts of the marketplace.
Right.
It's like,
right.
It's like you end up having these air pockets. That's why they correlate so tightly to the VIX, right?
Mm-hmm,
So
mm-hmm.
now, look, I could still be totally wrong on this. I'm kind of blown away by the virality of everybody now paying attention to this on X, and everyone suddenly being an expert on this when I've been pounding the table on this for a year. So I could still be wrong, right? Like I would not claim victory here, although everyone seemingly wants to on their end. Because the next phase of this, again, has to be the corporate credit side. If you don't have a follow through on corporate credit risk, then it came and went, right? And the thesis actually was incomplete, right? As far as it'd be like a C grade, right? But the point remains the same. This is how markets work. Things happen out of nowhere to shock people out of complacency.
Right. Let me ask you a quick question. When I was talking about like what was leading, and you pointed out VIX to whatever the high it was 62. Right. VIX is interesting. It's an interesting instrument. I don't think a lot of people totally understand it. I think you have a lot of insight into it. You've studied it. You've done some research around it.
You mean few understand this?
Yep. See, I'm missing these opportunities.
Come on,
left and right. So, to what extent do you think that VIX spike was truly an expression of essentially a cluster of volatility, a volatility explosion? And to what extent could it have possibly been simply thin overnight futures markets that don't take a lot to push around?
It's probably a little of both, and I'd throw in the mix there manic zero DTE type of dynamics.
Yes, which has really messed things up with our understanding of volatility, right?
Yeah, because and speed with which volatility is volatile, right?
Right, exactly. Yep.
Right. So, which is why actually the move is so weird to me. Also, if I were to have said to you prior to yesterday, the VIX is going to hit 60 in a single day, 65. It's like, how much do you think the S&P would have been down?
Oh yeah, I mean 20%,
7%, or right? Like what's a VIX spike? Like what's that? In most people that are watching this listening, it's like you think, yeah, that might be double digits in a single day.
That's a Black Friday event.
Yeah, it's Black Friday, right?
Or Black Monday, whatever.
Right, but at the same time, it's like, all right, well, so what? The SP was down, I think, at the worst 4.5.
Yeah.
But my point is like the magnitude of the spike was not commensurate with the actual drop in the S&P.
Exactly. Yep. Right. That's sort of my exact point, right? So, okay, but so you don't know. It's hard to say maybe to what extent that's sort of supply and demand for the VIX versus the distortion of the VIX by zero DTEs.
Right. Exactly right. So which again goes back to my point of why I don't think this is over. Because usually, I put out that post yesterday. I said, these are the VIX levels when the brave profit. Right. Because again, I know that it's not me being a permabear. It's about sequence potential, right? As far as how this works. So on the one hand, it's like, okay, a VIX spike like that, you should be buying. Right? Yes, you can get a lot higher in the moment, but that's actually tends to be a good risk reward dynamic. At the same time, the market didn't really drop substantially enough to, I think, make it super attractive. So is this the only VIX spike that we're going to see? I don't think so, because we haven't had the commensurate drop in the S&P to really flush out the complacency, which otherwise a high VIX level would tell you you've done. You see what I'm saying? Like that's it. And again, I go back to, I think the only way you shock the complacency is you have to shock default risk back into corporate credit.
Yep. And so this goes along the lines of, you don't think this is done. This is essentially the beginning of the event. The event is
thing that sparks it, right?
Yes, the event is the blowout in junk debt. So what will that look like to, from the perspective of a retail investor? Let's say credit spreads start to blow out. What's that going to look like to the average retail investor? What's going to be the effect on the equity markets for that? And how do you think people can be positioning themselves right now?
So a good analogy for this is junk debt is the equity equivalent of bonds. The utility sector is the bond equivalent for stocks. Right? Okay, so to the extent that junk debt is collapsing, equities will collapse. I mean, they have to, because junk has a higher claim on collateral in a bankruptcy proceeding than equity. Debt does, right? From the capital structure. So with junk debt imploding will come equities imploding for a moment in time. I mean, that's typically how it works. It would look also like and feel like a recession, because that's one of the characteristics of a recession: widening credit spreads. Because in a recession, things are slowing down, default risk is increasing. It's consistent with the uninversion of the yield curve. Like everything's, it's. There's nothing I'm saying which is like, I don't think controversial when you actually just think through history. It's just everyone got so stuck on the abnormal behavior of this cycle, which has been so dominated by one narrative around AI, that they're forgetting cause and effect and lagged windows, right, for a lot of this stuff. So, so I think it looks, and then from a sector perspective, it looks like, defensives end up outperforming cyclicals, utilities, healthcare, consumer staples, quality dividends outperform, growth names, blue chips outperform everything else. So it's not, I don't think it will play out differently compared to any other risk off cycle, right? It just takes a little time to play out.
Yeah. And so a risk off cycle, we'd also expect to see a flight to quality, right? So do you think this ends up being sort of a correlation one event, or is this something where, there will be places to play defense and places where people can allocate to besides cash, let's say?
I'm glad you said, because I put that post out. The one thing that goes up in bear markets is correlation.
Yeah, that's right. Yeah, I didn't even see that, but that's a good one.
Yeah, it was just no, but at the same time, I also said treasuries will stand alone.
Okay. Yeah.
And this has been one of the most frustrating things for me as a fund manager that knows the history of treasuries as a risk-off option, even pre-Volcker, going back to the 1960s. The narrative has been what? Treasuries duration are no longer a hedge. They're broken as a hedge. That's such nonsense narrative chasing based on price. Treasuries were never broken. You needed credit spreads to widen. So if you're going to have, that caveat to the only thing that goes up in bear markets is correlation. The other thing that goes up is the price of treasuries, right? When yields drop, right, on that end. And that's, the start of the next reflationary cycle. It goes back to cause effect is not broken here. I think a lot of people are being thrown off by the reality that if you think through what's happened in the last 4 years post-COVID, you're dealing with so many of these weird lags all at once. The lag of the shutdown, the lag of the reopening, the lag of the stimulus, the lag of the fastest rate hike cycle in history. And everybody says, well, all these prior relationships are not working. It's a new world. It's like, no.
Yes, this time is different.
Right. And it's like, of course not. It's just because we're still dealing with these reverberations of each of which of these is tremendously shocking, all happening successively in a very short time frame. It's like, you read any kind of history book on anything, 4 years, 10 years, 30 years, is often used as a way of describing how things would play out. 4 years is nothing.
Nothing.
And everyone's assuming that, that means like all these paradigm shifts that take place. Give me a break. This is nonsense. It just takes time for these things to settle out.
Do you think there was ever a hope of a soft landing? Or like would the Fed have been able to do this if they had managed it, if they had started cutting rates earlier?
I'm torn on this, right? Because you can argue that although them cutting rates against Japan raising rates only worsens the reverse carry trade, right? And and it becomes tricky because if they were to have done that with credit spreads as tight as they were, it would have been really inflationary, right? I mean, part of this is also just, I suspect the Fed probably took more of its cues from the high yield junk debt side, from the credit spread side, as a way of telling them they can keep on raising rates and keep rates elevated. And if they were looking towards credit spreads and credit spreads were wrong, then their reason for keeping rates as elevated as they were was invalid. But the same token, they probably had to, because junk debt was not allowing them the opportunity to liquefy, to give them a reason to liquefy. All right. So I don't know. It's hard because the Fed doesn't know when the lags hit. And so you've got the lag of the hike cycle, but then you have another lag when they cut. So the assumption there is what? That the lag of the hike cycle and the lag of the cut, they intersect at the exact same time. It's like, that's impossible. I mean, how can you possibly time that when they don't themselves know exactly the variability of the lags? It doesn't make sense.
Yeah. Even with the best forecasting, the best analysts in the world.
Of course.
These are, it's not that this time is different, but I mean, this time is different in, as you're saying, how compressed everything was, how quickly it all happened, right? And so it's hard to look historically and draw conclusions on what the lags would have been from each of these things in order to get the timing right.
That's exactly right.
So do you, I saw this question on the stream, are we in a recession now? Is that your belief?
I mean, it's not about what I believe. It's what 3 in 5 Americans believe, based on a Gallup poll, right? I mean, it for a lot of people, it feels like it. It's the old K-shaped economy. Right? It feels like the old K-shaped.
Right. Yeah.
Yeah.
Some
and you
people
can
are
see
doing very well. Some people
Yeah.
are doing very poorly.
I mean, small cap stocks look like they're in a lost decade. If they don't break out, relatively soon, and they look like a sideways lost decade. Certainly after inflation.
Yeah.
Looks like a recession there on a real adjusted return basis for small caps, for micro caps, not for the S&P, right? Which goes back to the nuances of the environment. This is why it's like people talk in such broad strokes about, in quotes, the market, but you have two very different markets, just like you have two Americas. I mean, we have to stop with this sort of these generalizations around things, because a lot of people are suffering and in pain, and a lot of investments are not doing that well.
Oh, sorry, you broke up a little there. I don't know if it was on my side or yours, but it came back. That's fine though. All right. So how have you said most of your funds have gotten it right? How have your funds been positioned for this? And what does getting it right look like?
The curse that I've had the last 3 years is that all my funds, ATAX, RORO, and JoJo, when they're risk off, they have to be in treasuries. Right. So you can think TLT as an example. So because for good reason, because usually treasuries act as the risk off play. Like, by the way, they have from Thursday up until Monday. It's like the flight to safety came back. Treasuries worked. You saw it momentarily. Right. But the problem is, the last 3 years, that's not been the case. As we know, it's been a duration sell off, not a credit sell off. I designed them to be credit risk off, not duration risk off. RORO, which uses the lumber to gold relationship, took it on the chin.
Okay.
Because it's entered risk on. And again, it's like, I did not expect, and nobody did. And if I did expect, it wouldn't matter, because the funds are rules based. I didn't think it would happen that suddenly in just that exact moment in time. It's funny, because even like when people were starting to talk about the reverse carry trade, it's like I'm on Twitter and X, whatever, Twitter, and people are commenting, and I'm honestly barely paying attention, because I'm on calls all day long, and it's like, all right, well, I guess my thesis is playing out. I guess I better lean into it. Gotta drop a couple of calls and put some funny memes and put a Godzilla movie. So
that was funny. I'll give you that.
Yeah, so it's like it happened so quickly and so aggressively. But again, I go back to path matters more than prediction. If I'm right that this is early, I'm hoping that RORO resinks, because in my world, whether it's utilities against the market, which is what JoJo and ATAX are using, or lumber to gold, typically those signals line up to say risk off in a coordinated way. This time it was not as coordinated, right? So I think that there's still a coordinated stars aligning for risk off moment coming. And I go back to, I think it comes from the junk debt.
Okay. So someone's asking, is buying UVXY a good idea?
No.
Disney is asking that.
No. Not investment advice, but no. I'm going to say no, because it's like shorting. It's gambling. Maybe you make some money on it, but it's like, well, trading volatility directly is almost a surefire way of regretting your life decisions. I don't know any other way to say it. I know the allure is there, but it just doesn't work.
Yeah, no, I'm with you, and certainly only if you're ready to actively trade it. That is not an investment to make.
Yeah, come on.
Right, and you're convinced that, again, this is the beginning. We're going to see another volatility spike. We're likely going to see another leg down, and it's really time to be defensive and in treasuries until these lags, let's say, permeate and work their way through.
I think so, but again, I've been wrong plenty of times. Right? I mean, I've been burned so many times in these cycles that I have little confidence in having. I have little confidence in saying that you can just proclaim victory right away. Right? It's That's again the nature of volatility. Yeah.
All right. Well, look, I know you got a hard stop, so appreciate you taking the time. This was a fascinating conversation. And if you don't already follow Michael, he's at Lead Lag Report everywhere, right? Twitter, YouTube, Spotify.
Spotify,
Yeah.
stuff.
He's putting out some great content, really insightful. So thanks for joining us, Michael. Much appreciated.
Thank you, guys. Appreciate it.
All right. We'll let Michael go, and Pink, I don't know if you want to jump up and we can sort of sum up the conversation. There you are.
Yeah, I'm here. Can you hear me? You probably can't see me. I didn't get my camera set up. Sorry, guys. I was producing. But yeah, there's a couple of more questions. I don't know if you're comfortable answering them. Yeah.
So Russ is asking, do we expect more recovery ahead of the next leg down, or will this be a quick turnaround? You know, it's a good question. Kambiz is asking it in a slightly different way. When next dumpster fire? It's a good one. Damn it,
Japan's trying to turn it around really fast, and I saw something earlier that said that the Bank of Japan was they're waiting to see what happens with the U.S. economy before they make any more big changes, and that's being the almighty dollar. It all kind of depends on where our economy goes, how it works out for everyone. So it could be a big dumpster fire brewing, or maybe it'll settle and we'll get that soft landing that we've heard so much about.
What I've noticed in the last several years of markets is that things move way. I mean, this is not insightful in any way. Things move way faster, but it's almost shockingly so. Like the last time we had like a more than 2% move down in markets was years ago, and it was like the fastest correction ever. And I think, look, we officially hit correction at one point yesterday, which is the S&P down 10% from its high. And now that's like over and done with. And so the question is this, as Michael's saying, like the first, the beginning, or is it done? Is it past? And
great recession, guys. Good game.
Yeah, good job, right? And I think I'm in the camp with him that this is what we're seeing today is very much a dead cat bounce. Like, you usually only see these rip your face off rallies in bear markets. And so I think that if that's sort of historically the case, and if that's happening now, I mean, look, the U.S. markets are not flying today. They're up not even 1% at this point, but the Nikkei is just going nuts. The Nikkei a week ago was at 39,000. At its low yesterday, it was at 31,400, and now it's back up to 34,600. Those are huge moves, like 20% move down, a 10% move up. Like those are big, fast stock market moves off the Bank of Japan raising rates. And again, you have to think about what he was saying, which is if the Fed were to come in and cut rates, if the carry trade is the issue, that can actually exacerbate the problem, because it's a sort of relative interest rate problem. So that if the Bank of Japan is raising rates and the U.S. is cutting rates, you're getting once again closer to where you were during ZIRP, right? Zero interest rates, when both Japan and the U.S. had zero interest rates. The carry trade is a way to get cheap capital and chase yield. So I don't know. All that's to say, I don't know. I fear that this is like, that we're gonna see some sort of, it's gonna hover. It's gonna do just enough to make people think it's over before the next drop.
I agree.
Markets like to do that, right?
Like Corpomancer just said, zigging and zagging, and a lot of volatility that's a lot of unprecedented volatility. So Tim kind of switched it up a little off topic, but thoughts on why retail investors can't log into brokers when there are major moves down in the market? Is this a legit glitch or something more sinister? Of course, we won't project on that one, but it's kind of funny that a lot of them seem to go down whenever there's a lot of volatility. Can't help but wonder.
Yeah. Someone posted something about this would make an excellent academic research study to see how retail investors' performance was on the brokers that they could log into versus the ones that they couldn't, on the premise that it's better that you couldn't get in there to sell. At the same time, it also means you couldn't get in there to buy, and if you are looking to buy the dip, you got totally screwed yesterday. And that's, I mean, I don't know. To me, it's retail brokerages not investing sufficiently in technology.
Agree. Their infrastructure. It comes down to it. We've seen it a lot on the back end dealing with, with me when I first started dealing with Computershare and stuff. You see these big companies and you think that they have the infrastructure to support it, but not always. And sometimes it's as simple as that they have archaic infrastructure. So, but that's not to say that they aren't pushing a couple buttons behind the scenes, because let's see, I think Platinum here said they don't want the poors to sell. So
yeah, I mean, I'm not going to argue with that. Certainly the way they look at the world. And I think a big part of it is a lot of these guys are like their infrastructure is actually older. Like a lot of these retail brokerages were built a while ago, and they're not keeping up and they're not investing.
They're still trying to catch up with digitization in the first place. That's something that I've noticed with a lot of
I know,
firms.
right?
They're
how much
still
trouble
like,
they have with DRSing,
paper
right?
certificates? Like what? So as with
Scott
everything, it takes a while for them to catch up.
I think that's a good point from Scott that Dr. Copper is pretty telling. So, the 3-month lag from copper to the stock market is holding true. Actually, I haven't looked at copper in a while. So, let's see what that's looked like. Yeah, I mean, that's like that peaked in May, came down pretty hard into June, back up in the beginning of July, and now way down. So now it's August 6th, and it's trading $4, where it was trading at 5. So it's down 20% in a couple of months. I mean, that's a pretty big move. Copper is usually, they call it Dr. Copper because it's usually indicative of the stage of the economic cycle. So copper is an industrial metal, and so industrial demand is usually reflected in copper. So as industrial demand goes down because the economy is slowing down, the price of copper drops. Kobiz says, don't shit on cobalt. Let's see, what's cobalt doing? Same thing. Here you go, cobalt metal, fast contract. Yeah. I don't even know where to pull up the price of cobalt. Here we go. No, not there either. All right, well, Kambiz, we'll have to take a look at cobalt another time, another stream. All right, I don't know, anything else, Pink, from you thought about what Michael said?
I just found it really funny that first of all, I want to commend him on, what was that, a 2-day fast? 3-day fast? My goodness.
Yeah.
I do well to do like 18-6 or 24 on just intermittent fasting. So the going multiple days, I'm gonna give him his kudos. That's intense.
I have never done more than I mean, I was telling him ahead of the call that I've done a 5-day fasting mimicking diet, which is low, like you're basically between 400 and 600 calories a day. And that, I mean, it's pretty close to fasting for that length of time. But other than that, I've only done that once, and I really only do 24-hour fasts. Although I do every day intermittent fasting, but I have to be careful because I need to maintain my weight. That's
you might blow away, huh?
Yeah,
Let's trade metabolisms for a day or two. How about that?
That's what everyone says, but you know what? You don't realize I got to take in a lot of calories. Sometimes, and I love to eat, but sometimes it's a bit of work.
Come down this way, and I'll have you hitting those calorie marks before midday. So, but no, Michael's
seriously, I have like 1,000 calorie smoothie every day.
That's crazy. He's lost a lot of weight. He looks great. Don't want to speak without him here, but he's doing a great job. So that was inspiring in itself. But he's been I don't know what it is about Michael's being the Cassandra of markets, but like he's been beating this drum for a while, and he came on. I'll share the link below whenever we get done with this, but he's been on before and talking about this for at least a year and a half with us that something is coming. Yeah. I put the Michael Burry thumbnail into the thumbnail, the little profile pic. If you're in the GME community, you'll probably remember that from a couple of years ago. He started talking about Japanese markets and things like that. So
yeah. Michael's controversial. I get that. We got some negative messages along with the positive ones, and that's fine. I think it's good to hear from people that you disagree with, or even someone like him who he's been wrong for a while and he totally owns up to it, and I think that's important. That's intellectually honest, and that's a good thing. And the markets are hard, man. If they were easy, there wouldn't be anything interesting here, or some people would be very rich. And if you're not working at Renaissance, good luck. So I think he's been looking at this in an interesting way for a long time now, and given that what he's been talking about has started to happen, it seemed worthwhile to bring him on and chat about it. And I think we're gonna now maybe now you understand a little better about what's going on, and as things play out, either they play out the way that he described them or they don't, and at least that way you have a frame of reference as you watch markets sort of, and you watch all this unfold. This is a good question that we just got. Will the next major crash be deflationary or will it be hyperinflationary?
Depends on who you ask.
It does. I'm of the camp that it will be deflationary. I think, I mean, again, like, I think what the Fed has shown, and we talked about this, in not cutting rates, is that they still think inflation is enough of a risk that they're willing to go into recession. Maybe the soft landing wasn't the goal. Maybe the soft landing brought too much risk of inflation coming back. I don't think it's going to be hyperinflationary. One, because the Fed has shown that they see it as a risk, and now maybe also has some of the credibility that they didn't have when people were all looking for a soft landing. And two, I think, as we've talked about before, especially with Claudia and Ophir, about the nature of inflation that we have seen, that so much of this inflation has come from both Fed policy and COVID, and the supply chain impacts, and labor market impacts, and stimulus impacts of COVID. So I think with all of that getting further and further into the rearview mirror, and the Fed stabilizing off the zero bound, and they're gonna be cutting rates. They're probably, the market thinks they're gonna end up at around 4%. That's probably where the natural rate is, and they're probably gonna hope to hold it there as long as they can. I mean, if they're able to keep rates at 4% for any real period of time, I think that's going to lead to a controlled re-expansion of the economy and keeping inflation under control. So I'm not sort of in the hyperinflationary camp. I know a lot of people are, and that's what they think the next leg is going to be. And maybe, but I don't think so.
Wiping our tears with dollar bills. That's what they think is going to happen.
That's right. Let's hope not.
Anecdotally speaking, it seems that greedflation, I've seen a few instances of it coming back down where it matters at the grocery store, and utilities and things like that. I think hopefully we're headed for a deflation.
So anyway, I think that's it for now.
Yeah,
I
we've
hope
got
everyone
2,000
enjoyed it.
people joining us.
Yeah, appreciate every one of you joining us again. The conversation that we're also having it over at Irvin.finance. We hope you'll join us there. The forums are fun and we're having good conversations there. Also join our YouTube channel, Irvin Finance, and hopefully we'll see you there. That's where we put out our content. And also, of course, I'm sure most of you are joining on Twitter, and that's where we're streaming this. So thanks again. This was sort of a special live stream of Let's Talk Markets. And thanks, Pink, for joining me on this. And we will catch you all next time. You should register to vote. That's important.
Vote.org. Bye, everybody.
There you go. All right. Bye.